The rumor that moved a $12 trillion market, unveiling the impact of U.S. tariffs on gold trade. The mere whisper of a potential U.S. government decision to impose tariffs on 1 kilogram gold bars from the specific countries caused an immediate ripple effect in the global gold market. Gold, a precious commodity historically viewed as a store of value and an essential element in financial trading, saw its price volatility surge within moments. The rumors about U.S. tariffs, if enacted, would shake the very foundation of how gold is traded and transported, especially concerning futures contracts, logistics, and trade flows. At the heart of this disruption was a discussion about a potential 39% tariff rate on gold bars from Switzerland, a significant player in global gold refining. The impact of this news was felt instantly as futures contracts in the U.S. began hitting new highs, indicating rising expectations about gold's future value. Meanwhile, the spot market lagged behind, which led to an increasingly widened spread between the two. This created an environment of heightened uncertainty as traders tried to gauge the precise ramifications of these tariffs. The immediate impact on the market was felt not only in price fluctuations, but also in physical gold trade flows. As rumors gained traction, refinery players and logistics operators quickly adopted a wait-and-see stance. Shipping teams suspended flight plans as they sought clarity on the ambiguous language used regarding U.S. Customs classification of gold bars. The critical question for traders was which type of gold bar would fall under the tariffs and how this would affect trade classifications, further increasing uncertainty. What's truly fascinating about this moment in the gold market is the interplay between speculation, logistics, and the global financial system. The rumors about U.S. tariffs on gold bars, specifically the 1 kilogram variety, were tied to the unique role these bars play in the market. 1 kilogram bars are highly liquid, easy to transport, and widely accepted in contracts, making them a crucial tool for arbitrageurs and traders. When the threat of tariffs on these bars was introduced, it added a layer of complexity and risk that was not immediately calculable. In essence, the gold market was suddenly facing an acute logistical crisis. The widening gap between the futures and spot markets was a direct result of uncertainty about which specific bars would be affected by the tariffs. The risk of a bar falling under the tariff classification meant that forward contracts would need to be delayed, creating a ripple effect across the entire trade chain. Market participants, including arbitrageurs, had to recalibrate their expectations, factoring in not just the gold's price, but the added costs of shipping, insurance, and delivery time delays. Gold's dual role as a financial asset and as a physical commodity played a critical role in amplifying the initial panic. As futures prices surged, traders also had to contend with the broader implications for physical gold logistics. With key trade routes uncertain and the risk of tariffs looming large, many chose to hedge their bets and pull back from aggressive buying and selling. The price difference between the futures and spot prices reflected the market's nervousness about future trade conditions. If you found this video insightful, don't forget to hit that subscribe button. Stay tuned for more updates and content. We've got plenty more coming your way. In such a situation, the futures spot spread, essentially the price difference between gold delivered in the future and gold traded immediately, became an important indicator of market sentiment. When trade logistics are disrupted, as was the case with the tariff rumors, the spread can quickly expand, signaling uncertainty in the market. This gap is often driven by the added complexity of securing shipments, the potential for further delays, and the unclear timeline for any U.S. government statement or action. At the heart of this trade disruption were the questions surrounding gold's classification under U.S. tariff codes. These are not merely technical details. They are the bedrock of the global gold trading system. If certain bars were suddenly subject to tariffs, the entire trade chain would need to adjust to these new realities. Without clear guidance from U.S. authorities, the market would be stuck in a limbo, waiting for official confirmation before it could return to normal. As the hours passed, the initial panic began to subside. The market slowly moved toward a partial equilibrium as more information began to emerge. However, the core issue remained: which gold bars would be subject to the tariffs, and how could market participants mitigate the risks posed by these new costs? The role of 1 kilogram bars in the gold market. Why specifically 1 kilogram gold bars? This weight class is especially critical due to its liquidity, purity, and deliverability. Gold bars of this size are traded globally in large volumes, and they fit easily into the infrastructure of both the futures and spot markets. They are also highly standardized, meaning they are easy to assess for both purity and value. For these reasons, they are the preferred choice for many financial contracts and transactions. If 1 kilogram bars were subject to tariffs, it would disrupt the smooth flow of gold in the trade system. The decision to impose tariffs could turn this highly liquid asset into a logistical bottleneck. The entire process of buying, transporting, and delivering gold would be subject to new, unpredictable costs, pushing the market price upward. This would particularly impact the arbitrage community, whose profit model depends on minimizing these trade costs. The market was left in suspense as it awaited clarity from the U.S. government. Refiners, logistics companies, and jewelers all paused their activities, unwilling to take on additional risk without clear guidelines from Washington. Shipping operations were particularly affected as ambiguity over U.S. customs classifications created confusion about which gold products would be allowed through U.S. ports. The diplomacy behind gold trade classifications. Another layer of complexity in this situation was the diplomatic response, particularly from Switzerland. As one of the largest refineries of gold, Switzerland's role in this market cannot be overstated. If U.S. tariffs were to be applied to gold from Switzerland at a high rate, it could trigger negotiations over exemptions and further complicate trade routes. Switzerland's government was likely to play a crucial role in shaping the final outcome, and any delays in tariff clarification would likely push trade flows into a state of uncertainty. The broader economic impact, consumers and market confidence. For consumers, the potential impact of these tariffs is twofold. In the short term, jewelry retailers would adjust their prices based on market momentum, but these adjustments are unlikely to be large enough to drastically change consumer purchasing behavior. However, if tariffs remain in place for an extended period, the cumulative effect on jewelry inventories and taxes could push up prices. For electronics manufacturers, who rely on gold in the production of certain components, any delay in U.S. gold deliveries could disrupt production schedules, forcing companies to seek alternative sources. If tariffs also affect other countries' gold exports, the trade risks will increase, raising prices across the board. The longer this uncertainty persists, the more likely it is that the broader economy will begin to feel the effects. Higher gold prices, tighter credit conditions, and increased trade uncertainty will all contribute to a slowdown in consumer spending. If you found this video insightful, don't forget to hit that subscribe button. Stay tuned for more updates and content. We've got plenty more coming your way.